We've been saying for some time now that investor caution is warranted, with risk outweighing potential reward in many asset classes. The recent Brexit vote has only added to the global headwinds facing markets, and we expect volatility to remain high as markets digest the potential economic and political impacts of this decision. That being said, central banks are likely to remain accommodative, with the US Fed now unlikely to raise interest rates in the short term and other central banks standing ready to inject further stimulus into markets if required. But also, market confidence in central bank policy actions is being questioned. So we face a lot of uncertainty going forward, and we believe that it's prudent for investors not to become too complacent. Volatility has spiked significantly higher in June, and it is likely to remain elevated given the challenges ahead. Markets generally do not like uncertainty, and unfortunately it looks like we will be faced with both market and geopolitical uncertainty for some time to come. Following the Brexit vote on Friday, traditional safe haven assets such as cash and government bonds protected capital. However, risk assets including shares, listed property and infrastructure also down hard. Losses were particularly noticeable in European equities, with Germany down 8%, France down 7%, and Italy and Spain both down 12%. Banks were also sold down aggressively, with Deutsche Bank down 14% and Royal Bank of Scotland and Barclays both down 18% on the day. So far this week, we have seen that selling pressure continue. In our view, this is not the time for investors to take on more risk. Whilst we're not recommending to sell investments, we're not buyers at this stage. Hindsight will tell us whether this was a buying opportunity or not, but we believe right now it's prudent for investors to remain cautious. Volatility will be elevated and the potential for downside risk is quite high. So we've said for a while now that investors really need to ask themselves the question, am I being rewarded to take on risk at this point in time? So whilst risks are high, there's still investment opportunities out there that we actively recommend in volatile periods, namely absolute return strategies and alternative assets that have the potential to provide positive returns in both rising and falling periods. Our portfolios have been holding quite large exposures to these types of strategies, with the aim being to provide downside risk protection when the need arises. To date, that has worked very well, and we continue to expect it to work well going forward. The current environment remains challenging, and we're focused on holding higher quality assets rather than higher yielding assets, having a reduced exposure to assets that are purely reliant on markets having to rise in order to generate returns, and having an increased exposure to absolute return strategies and alternative assets that aren't reliant on those markets to rise. And overall, having a portfolio strategy that can meet investor risk and return objectives. So going forward, we're going to hear continued talks around Brexit and other geopolitical risks. And then this weekend, we head into Australia's election. And sub that, we expect that the markets will start to focus on US second quarter earnings throughout July to really see where markets are. We expect this period to be volatile, but our current portfolios are positioned for these types of volatile and uncertain periods. Thanks for listening to this update, and please contact your Morrows advisor if you'd like to discuss your portfolio specifically.